for the first time on the BQ platform, we're getting one guest who runs a long short fund, and we've been talking about getting him on air for about 2-3 months now. We finally have the opportunity, and this is the first time that I'm talking to Rajesh Bhatia. And Rajesh, great having you. Thank you for taking the time out today.
Hey, Niraj, thank you so much for having me.
Now, the pleasure is ours, Rajesh. And quite frankly, for a lot of people who are in the investing world, Rajesh, who are listening this right now and will hear this and read about this over the course of the next couple of weeks on our platform, investing is always long only.
Yep.
I request you, Rajesh, over the next 10, 12 minutes to tell us about your firm. What do you do? And why is it that long only is not necessarily the only way to make money in the markets?
Sure. So thank you, first of all. ITI Long Short Equity Fund, the firm that I represent, is a fundamental long short equity platform, right? Now, I want to tell you that this business is a $4 trillion business globally, whereas if you look at it in India, it is, taking baby steps. You compare that $4 trillion to a $5 trillion active mutual fund market in America. So this is that large an opportunity. And the strategy that I manage, long short equity, is over $1 trillion in size, right? So this is really a big market. Basically, this is an alternate way to approach equities. As you correctly pointed out, India is a very conventional market. Most people, whether they are participating in mutual fund, AIFs, PMSs, are all long only funds, right? And there is really no alternate approach to equities. Now, surely, you want to participate in equity, which has been the best asset class in India and in the United States. In India, over 42 years, equities have compounded at 16% per annum. Now, that's a phenomenal rate of compounding and wealth creation, right? But equities come with their own volatility. So let me give you an example of 2008. It was the worst year in equity, worst year for equities in India in 30 years, when the markets dropped about 55%. It took 6 or 7 years for you to reach your principal value, right? Now, one rule of investing, which is probably underappreciated, is that if you want to compound at an attractive rate, go ahead.
Rajesh, sorry, can I just ask, are you going to share a presentation, or should we share a presentation that you may have shared with us along with this, or would you want to start it later?
No, you can, I can share that presentation. Please go ahead and put that presentation on.
Okay, hang on. I presume you're talking with reference to that presentation, which is why I brought up that point. So let us just try and do the slideshow. Just give us a second, Rajesh. Yeah, and Rajesh, would you tell us when we have to flip I think we can go on to the next slide, but after that, Rajesh, you please tell us and we'll flip the slides.
Sure. So the point I was making is that basically the 2008 episode, where it took 6 or 7 years to come to your principal value, right? And the investment principle that I wanted to point out, which is slightly underappreciated, is that if you want to compound at an attractive rate over a long period of time, you need to protect downside, right? Warren Buffett says, rule number 1, don't lose money. Rule number 2, never forget rule number 1. I think he has this point of compounding in mind when he kind of makes that point. Seth Klarman more recently talked about 30 years of compounding can be taken off if you have one bad year, the 31st year. So if you have compounded, let us say at 15% for 30 years, in the 31st year, if you have a 50% decline, your CAGR becomes 7.5%, right? So it's extremely important to protect downside. Now, why am I bringing this up? Because while there are many types of long short funds, in India included, this is what we do. We aim to value add by providing an asymmetric return profile. So what is an asymmetric return profile? Which is, when markets decline, we protect the downside. And when markets go up, we participate in an equity-like manner. With the result that as markets go down and go up and go down, over a full equity market cycle, we can beat the market with much lower risk and much lower volatility. So that is really what the objective of our fund is. So there are two aspects that we bring to the table as far as our fund is concerned. One is the bottom-up fundamental stock picking approach, where you long certain stocks and then you short certain stocks. And the second aspect is altering the equity positions depending upon how we see the market opportunity. So that's what ties in our market view, which I'm just about to present. That, it's okay for a long only fund not to have a market view, right? But for us to navigate markets, we need to alter our equity positions, and therefore we need to have a market view. Now, if you just step back, what has happened in the equity markets since the COVID crisis is that there was a one-way rally in the equity markets. Now, my sense is this was entirely led by these developed market central bankers unleashing of monetary policy. You had the quantitative easing one starting 2009, where the top 10 central bankers, which had a balance sheet of 7 trillion, went up to 20 trillion before the COVID crisis started. And now to address the COVID crisis, they added another 13-14 trillion dollars. That's a lot of money supply that was added to the system. Plus, to address the COVID challenge, let us say the United States alone, which is 25% of world's GDP, by the way, had the largest fiscal deficit since the Second World War. So that is the kind of money that was thrown at the problem. What was the effect of that? The effect of that is, at one point in time, $18 trillion of bonds were in negative yield territory. When interest rates come down, valuations of assets kind of go up. So the effect of this decline in interest rates was that asset prices across the globe went up, including equities and including in India, right? So this is a very, very macro-driven market, right? But the consequence of such a large unleashing of money supply was that now inflation has come to roost, right? So as inflation is becoming a bit of a challenge, you have to now alter this unleashing of liquidity, and you have to kind of take it back, right? And as you take that back, and as interest rates kind of go up, it's going to have a effect on your valuations of assets, just like it was favoring you, as the liquidity was unleashed. I think what typically we do as analysts is we focus on EPS growth. But market prices are determined by two factors: EPS growth and price earnings movement. I think the market, being extremely macro driven, have been more a function of price earnings movements. So it went up when liquidity was unleashed, and now it is coming down. And while that is taking place in the US, I think Indian markets since October have been fairly complacent about this. We kind of talk about how FIs were sellers who could see that Indian markets were quoting at premium valuations, and the risk of this unwinding of liquidity was taking place. The DIIs and the domestic investors were more optimistic, feeling that this inflation problem is transitory. But clearly it is not proving to be transitory. Also, I think the Indian markets were a little complacent, thinking that the global market challenge are not necessarily our problem, right? But I think more and more people are recognizing that as the globe goes into a slowdown, in fact, there is even a threat of a US recession. China is already slowing down, and so is Europe. As global markets or economies slow down, it will have an impact on our growth as well. So even our GDP is going to slow down. And if you look at the other context, our interest rates are going to also go up because inflation is stickier in India as well. What started off as PPI inflation now has become a CPI inflation. So if that is the case, interest rates are going to go up. There is going to be a growth slowdown, and therefore it is going to pressure our markets. The catalyst for Indian investors waking up to this challenge, my sense is, was the RBI increases interest rates, which took everybody by surprise. And basically that was the catalyst, and that's the reason why you're seeing such a quick fall in the markets, because I think the market mind of the Indian market shifted that, oh, these challenges are for us as well, and these are not uniquely to the global markets. Given that what the inflation numbers that you're seeing in the US, I think there will be a need to move interest rates very fast. Otherwise, I think the inflation angle is going to get a little out of hand. So my sense is the risks are front-ended, and I think the Indian markets will also react to that. Now, just a additional point, I think the next two charts also will bring some of that out, if we can move to the other one. So where are we? Some people are still finding the bottom in the Indian equity markets. Now, let me just provide a context to that. So our long-term average of price earnings has been 15 times. As we speak, we are at probably 16.5 to 17 times 24 earnings, right? Now, even if we were to revert to 15 times, which is the mean, we are more likely to fall by about 12%. Now, let me give you another context here. I think this is less recognized in the Indian market, that we've almost seen a minimal bubble in the September-October 21 period, right? So why do I say that? You saw enormous late stage behavior. These typical late stage behavior you see at the end of the cycle. If ever you've been familiar with the Harshad Mehta cycle, the 2000 internet bubble cycle, or 2008 cycle, you would see that the retail enthusiasm goes up only at the late stage of the economic cycle, right? Or the market cycle. Here, even before our economic expansion had begun, we saw late stage behavior. What is late stage behavior? IPOs getting valued crazily. If you remember and recall 2008, Reliance Power IPO got subscribed at 1 lakh crore market cap. There was 1,60,000 or 1,80,000 crore futures and options position dominantly by retail investors. Concept stocks going crazily valued. Construction companies which never made free cash flow in their lifetime getting a price earnings of 30, so on and so forth. That is late stage behavior. I would argue that you saw late stage retail behavior even in September and October of 21. IPOs got crazily valued. Concept stocks got 100 PE. Futures and options, massive speculation, especially driven by retail. Now, why am I bringing this out? Every time a bubble has burst, the equity valuations have gone to the other side. It goes to the excess on the undervaluation side. So it's something that we must keep in mind, that if we have come off a valuation bubble, that it's possible that we may go to the other extreme. Without that, also, as I'm pointing out, we are at 16.5, 17 times earnings. Even if we gravitate to about 15 odd times earnings, that's a 12% downside. Now, anybody who believes 12% downside is not meaningful, please remember that I think we have only corrected by 15% from the top. And almost it feels as if a lot of people are devastated with their equity returns. So my sense is that there is probably another 12% that's there, and it's something that we need to keep in mind. Now, I just want to make one point. I run a long short fund. I need to be fairly tactical. So the way my thought process is that I am in the George Soros camp, who says, build a thesis and then take it out of your system, and then look for contrary signals to poke holes into your own thesis. So as you move forward, as I see these risks, I will evaluate what follows. If the data or news flow is to the contrary, I will be amenable to changing my mind. Or if the data gets more bearish, I'm amenable to getting more bearish from here. So that is also what I would encourage people to kind of keep an eye on, and look at this aspect. And it's something that, as a long short fund manager, I also have a thought process around that. So that's something that I just wanted to bring to the table. So that is really what I want to talk about as far as market views are concerned. Niraj, I also have stock opinions or sector opinions, but over to you, and we can talk about whatever else you think is appropriate.
No, this is great. Great. Rajesh, thanks for setting the context. And I'm glad that you are, we'll come to this in just a moment, but Rajesh, just a quick thought. So when you say that you presume, you believe that there will be um, okay, let me try and rephrase my question. The most common commentary that people hear is that if you're buying right now in this pain over a 24-month period, you will be sitting with happy portfolios because you're buying value or you're buying stocks at lower value and eventually they'll move higher. The dip getting bought is the most commonly repeated phenomenon that has happened. Can this time be different wherein the dip doesn't get bought or doesn't get bought with the same ferocity as it has happened in the last few times?
Right. So forecasting is, difficult, especially about
Hey,
the
you'll have a
future.
long short fund.
But so we also take it as it comes. And but here is what I would tell you. The markets have been used to a Fed put, right, all the
Yes.
time. So the buy the dip mentality was encouraged by the fact that the Fed is always going to be there to have the markets back. You should know that given where the inflation challenge is, the Fed put is no longer available. I don't think the market participants are going to be very comfortable with that. In fact, forget the Fed put, the Fed is going to go far more aggressive. In fact, I would bet, forget the 50 basis points. My sense is that they will have to raise it by 75 or even 100 basis points because inflation is really getting out of hand. So my sense is that one context that you need to keep in mind is you no longer have the Fed put. Second is, I think you need to understand, at least as far as I'm concerned, are we seeing a bottoming up out of news flow? Are we seeing valuation in an attractive zone? Are you seeing bottoming out of sentiment? In my understanding, none of these are bottoming out. So news flow has just started. It's only when the interest rates in India were increased that the Indian investor got up a wake up call that, oh, we can also be impacted by global growth and global inflation. So that news flow has just probably started, and the data in anywhere is suggesting you that we are moving towards a stagflationary situation. So the news flow has not bottomed out. Sentiment, in fact, I look across and I see that most people are really trying to catch a bottom. So
Yes.
when so many people try to catch a bottom, that's not
That's on the bottom.
that's not the bottom. And as far as valuations are concerned, again, I pointed out, we are still in premium valuations, even if you consider 24 months or 20 months ahead valuations. And whereas our average is far lower than that. So, so those are three things that I would consider. I would not argue with anyone who says equities are one of the best asset classes for the long term. Please, I would not argue with that at all. But I would say that these are some things that at least as a long short fund manager, I am going to consider.
Got it. Rajesh, one follow-up. What can prove this? So your thesis or your basis of the reasons why you're making this call sound very convincing. What can change this in a world like where we are right now? What could change it?
Sure. So first of all, if you can go to a slide prior to that, that is important as well. This change tells you how the changes in reserve and how stock market prices behave, and that's what I told you, that changes in reserve are going to be tightened. So there is implication of that. There is good correlation to markets. What can change my mind? Like I said, I'm open to new data and I will keep evolving my view. I'm more than happy to that. That's really the real mind of a good investor or a fundamental trader. Two things. One is, in case the mind of the market changes, that inflation is peaking. Now, there are a lot of participants who are pointing out that inflation, by the way, is peaking everywhere, right? And my sense is, if there is some mind of the market which shifts towards that, and there is evidence towards that effect, I will change my view. Second is oil prices. If oil prices collapse, $40, $50, $60, wherever that goes, that can be very, very beneficial to India. and that will also take away some of our pressures that I'm talking about. And so those are two aspects that I'm watching out for as we move forward. Having said that, I think oil is also a risk for India. So I think, given where there is discussion in Europe, which Hungary is probably holding back the European Union from doing, is that they are talking about sanctioning Russian oil. Now, market observers would tell you that in case that happens, and if some part of Russian oil is taken away from the system, oil prices can go up. Now, I can tell you, even at $120, we are going to have a meaningful balance of payment challenge. Forget it going up higher than that. And that can be quite bad for us. So I would say those are the first two things that I pointed out. The other things that you need to watch out for. But I don't think at this moment it's too early to think that that is changing. Even the inflation peaking out thesis is not going to pan out in the next 1 week. It's going to take several readings of inflation for the market to get convinced that inflation is actually peaking.
Got it. Okay. Rajesh, one final macro question before we get to your themes. And that is, can it happen that, because we keep on hearing companies talking about still being on the capex path. Yesterday, a couple of auto names have also done the same.
Yep.
Can it happen that the economy thus far, okay, let me lay the context thus far, and you know this, but I'm laying the context for the audience, whoever little doesn't know this, that thus far, even if the economy was not doing well, the markets used to move higher, and the economy, with the presumption that the economy will follow. Can we have a situation, Rajesh, wherein the economy doesn't do as badly, but the market still stays stagnant?
Well, I pointed out earlier that this is more a PE-driven market than an EPS-driven market. I think we underestimate the fact that this is a macro-driven market led by the top central bankers of the world, and their pushing and pulling monetary policy does impact us. Having said that, I think you need to be realistic about where we are. Now, if inflation is really galloping across the world, I think you need to consider the fact that central bankers are seriously behind the curve, which means that they will need to take interest rates much higher. There is almost now I wouldn't say a consensus, but there is some worry that you can't bring inflation down unless you trigger a recession in the United States. Like I said, it's 25% of the world's economy. You are seeing the challenges with China and Europe as well. Now, if global growth were to slow down, which I think the probability of it is not just 50%, it's far higher than the 50%.
Sure.
Right? And if you need to bring that down, it will certainly have an impact on our GDP growth as well. So there is a number that somebody pointed out that in case US does goes into a recession, our GDP will be shaved off by 1 to 1.5%. Right? So given those challenges, my sense is it's still very early to start thinking of a change in this thesis. We will have to allow a few months of more evolution before we even talk about the change. For the moment, like I said, the risks are front-ended and to the downside.
Okay, so even on the growth side, not that you believe that growth can show any positive surprises. Okay, so in light of that, Rajesh, can I ask you to talk about? So we had done this umbrella conversation about how people can watch out for 5 key stocks to monitor. Right. Can I ask you for at least 5 key themes that people should watch out for? People will try and pick up leaders. We'll try and talk about businesses. They need not be recommendations from your end. So these are not going to be buy, sell, hold ideas in any fashion whatsoever. But maybe we can talk about what are your themes and what within those businesses, within those themes, some businesses which might be doing the right things or the wrong things, if that is something that is within your limits of talking on our media platform. But maybe you can start off at least with the theme. So if we move to the next slide, I think those are the long-term themes in the market, going long themes in the market. I think this is what Rajesh is trying to say, really. Yeah. Rajesh, can you please elaborate?
So in an environment where inflation is a challenge, you should look for companies which have pricing power, which can be absorbed by the customers. Now, Telecom is definitely one of the themes. One, because it has low cyclicality of revenues. While there is going to be some challenge of upgrading customers, but cyclicality of revenues, the customer is still going to be a little more sticky. Also, we have the world's lowest tariffs, as I think all telecoms companies would point out. And there has been an improvement in pricing power given the consolidation in the business. Clearly, the top two players in the market are taking away greater market share, and the third player is becoming weaker as time elapses. Given this consolidation and the ability to improve pricing power, my sense is in an environment like this, telecom certainly is going to be a thesis that you must be long on, right? The second thesis I want to talk about is IT. I think while, as a fund, we have been extremely bullish on IT, particularly in the last 2 years. But over the 4 years that we have been in existence, IT has been one of the largest overweights for us. Having said that, we have taken that money off the table to a significant manner. And why have we done that? We have done that because of the two challenges that I mentioned. One is that given CPI at 8% in the United States, apart from the challenge that they are seeing in India, which is of employee costs going up, they're going to see employee costs going up in the United States as well. There is a trend of the great resignation in the United States, and there is going to be cost pressures for them from on the domestic as well as the international side. And as I pointed out, there is a risk of recession in the US. So given that context, there is possibility that the market may think that this strong growth rate that you're seeing right now, some part of it might get shaven off. Given those two top-down macro challenges, then you have to ask, is it in the price? Given how well IT has done, and given how much Indian investors have taken to IT, I think the valuations are still very premium, especially in the mid-cap IT space. The valuations are still very premium. My sense is, as those valuations correct, they will become good opportunities, because my sense is that these are long-term drivers. Now, if you listen to the CEO of Microsoft, Satya Nadella, he would tell you that today we are spending 5% of GDP on IT. In 10 years, we're going to spend 10% of GDP on IT. So technology is really all pervasive in all organizations. Given that context, IT spending is going to grow in double digits over a decade. Now you have to think about who can provide this kind of IT personnel. India has 5 million IT engineers with an extremely strong ability to train 500,000, 600,000, engineers on IT services. 500,000 is not even the number of people that you can get probably in several geographies. I don't know, Ireland, Israel, So this is how much we can add every year. So Indian IT companies are strongly poised to capture this incremental market share. So my sense is, apart from IT spending growing, this is a long-term theme. These companies will continue to gain market share as well. And these are very high free cash flow companies. Also, in the shorter term, will benefit from the rupee depreciation that takes place. So again, from a medium-term perspective, I think you should kind of look at IT as a secular theme. And now, auto, Niraj, I think you pointed out what has happened in the automobile business, particularly two-wheelers and commercial vehicles, is that compared to financial year 19, let us say they were selling 100 in financial year 19. Today, they are selling 65, right? That's a 35% decline. But as we would tell you as a long-short fund, protect your downside, because you need to come back by 50% to come back to your original base, right? That's the mathematics of decline. You need a 50% rise. Even if that 50% rise or back to normal volumes happens over 4 years, 5 years, that's a double-digit growth in volumes alone. Now, you are at this moment scratching almost close to the replacement cycle type demand at 65, right? And these are very good quality, highly profitable businesses and who have shown enormous ability to pass on costs. The average cost increase has been around 20 to 40%, and they passed all of those costs on. So in case volumes go up, the risk return in the auto sector, my sense is attractive, although I don't know how they will pan out in the shorter term. So if you have a 3 to 5 year perspective, my sense is auto is a sector that you need to watch out for. So those are three of my long themes.
Can we just probe this a little and then move on to the two short
Sure.
themes as well? And
Sure.
it'll give people a sense of what we're trying to talk. So let's start with autos. It's a fairly diverse set of companies. And over the last 2-3 years, while maybe two-wheelers, maybe four-wheelers haven't done as well, tractor companies have actually had patches of fairly good performance and mixed performance as well. So it's a very diverse sector. What within autos do you think you like the most and why?
So I would say if you have to add something to that. So if ever there was economic stability, I would say commercial vehicles can do extremely well, right? So you have to add something to that. If I get comfortable with the economic cycle, I think probably the quickest and the largest gains will be made in the commercial vehicle bracket, right? The tractor segment, some of the stocks are not at expensive valuation. In fact, they are quite a reasonable valuation. But tractor demand, unfortunately, has seen very, very strong couple of years demand. So there is always a fear that is this peaking? Fortunately, it may not be this year, but there is always a peaking of demand. Now, automobile companies quote at the lowest P at the peak of their cycle and vice versa, right? So that is something that you may need to consider when you're looking at the tractor opportunity. As far as two-wheelers are concerned, valuations across the spectrum, depending upon how you look at the company, I wouldn't only look at price earnings ratio, but even for some, price earnings ratio are extremely low, right? So you've seen a traditional leader in the business quote at less than 15 times earnings, a very, very strong wealth creator for 30 years, quoting at probably 15 or 16 times earnings, and a very smart player who's been gaining market share across scooters, exports, three-wheelers, etc. Quoted a slightly, larger premium, but, has been a gainer of, let us say, market share, etc. So some people may want to bet on something like that, given that they've shown agility and ability to gain market share across. So it's for you to choose. But my sense is when these things do well, all will do well.
Got it. Okay. So viewers, Rajesh at least prefers the commercial vehicle segment. There are two main players, maybe some financiers out there. So I guess there is indirect and direct ways to play all of these as well. Rajesh, thanks for that. So that's that one theme, and viewers pick and choose. Rajesh, I presume you're choosing the pure play CV players as opposed to the financiers and the auto ancillaries, right?
That would give some of our topics.
Okay, fair call. No. Let it be. No problem. Whatever you're comfortable with, no problem. This is fine. But I'm okay. Fair call. But
but Niraj, you're right.
Okay.
Let me just nutshell that.
Perfect. Yeah, sure call. In IT, Rajesh, again, I would bifurcate it as 4 pockets. Please let us know what works for you per se when you're talking. So the commentation of managements are good across, so to say. But in large cap, there are a couple of buckets wherein the slightly expensive top 2 and then the not so expensive other 3. Then we have the mid cap IT space, which is largely homogeneously expensive, some more than the others, but largely more expensive. And then there's this ERD companies, which are terrifically expensive, but their commentaries are probably the strongest currently from all that I've seen at the end of Q4. So, and correct me if I'm wrong, but I thought these are the 4 buckets. There could be more as well.
Sure.
What within IT do you like and why?
So my traditional bias, unfortunately for me, has been the enterprise-oriented companies. And that's because I find I have greater visibility or understanding of that space, because I don't know how cyclical ERD companies can eventually pan out to be, right? And that's probably been a that's been a phenomenal spot actually. But unfortunately, I didn't participate in those. I kept myself to the enterprise side because the enterprise IT spending is where I feel I have greater ability to understand where those demand trends are moving. Um, and I would say that, there are some mid-cap IT trading at a premium, and there is some large-cap IT which are trading at lower valuations. I think people make a mistake, and you would see that across a lot of people who recommend IT, that they would say this quotes at a lower PE and therefore is more attractive, and this quotes at a slightly, the mid-cap IT quotes at a higher PE and therefore is not attractive. I think that is a mistake. Please look at the last 5-year returns. The higher P stocks would have given you tremendously more wealth creation. So I don't think price earnings alone is a determinant of cheapness and value. So that's one lesson. And the second thing that you have to keep in mind as far as the mid-cap IT is concerned is they evolved in the digital environment. They don't have as many of their legacy businesses, right? So therefore their growth rates are significantly higher, and they don't have the baggage of decaying or declining old businesses, and that's something that you need to keep in mind. So my sense is that I am more looking for, when I look at companies, energy in terms of earnings expansion. And that I feel is far more in some mid-cap IT and some large-cap IT. There are large-cap ITs which had been, which were leaders in the market at one point in time. They fell really short because they had management transition challenges, etc. They had to invest almost 500, 600 basis points of margins to regain competitiveness in the digital space, right? Now, the investments that you make in IT services is through the P&L. So when they had to improve the capability of their workforce, they sacrificed margins. Now, so we of course made it one of our largest positions at that time because those are the best, right? Where the price earnings contracted to 14, 15 times. In fact, it was available at, given that they were going to give a special dividend, it was trading at 7.5% dividend yield, 14 price earnings, and they had already taken the margin shock. Now you could have had improvement in top line, a change in the margins, and price earnings could expand, and that's what creates multi-baggers. So risk return, the point I'm alluding is risk return is a very underappreciated aspect in investing, and when you have EPS expansion and PE expansion, that's when you have multi-baggers, right? In a market today where a lot of thought process is even if you buy high PEs, you will compound at an attractive rate, or even if you buy digital companies at outlandish valuations, you will make great returns. I can tell you, nothing is more true to the contrary. The best returns are made when you have EPS expansion and PE expansion. So coming back, my sense is that there are some large IT companies which are growing at a fantastic pace, have absorbed some of their past challenges, and there are mid-cap companies which have energy and the portfolio to grow at an attractive rate. Those will be the ones among my preference.
Yes, just so that the way I put up the distinction, that's how we do when we look at stories on our platform. Large cap IT are the top 5, which are, by that I mean the nifty names. Some non-nifty names are not technically mid caps anymore. They are also large caps in their sense, just that compared to the nifty names, they are mid cap in size. So the large caps are the TCS, Infosys, HCL Tech, Wipro, and Tech Mahindra. And then the non-nifty ones would be the Mindtrees, LTIs of the world, and Emphasis thrown in there. And then the slightly smaller names like Birlasoft and the Persistence. And then, of course, the ERD companies, which is the Tata Elxsis and LTTS and maybe a KPIT thrown in there. So that's how I had distinguished the names, and Rajesh gave his thoughts on what he likes there. I hope that helps you. Telecom. There is one pure play telco, one conglomerate, and one player which is trying to survive. Even if you don't want to give us the clues, people will pick up the clues, Rajesh. Unfortunately, that's the nature of the beast as far as this goes. But my only question is, telecom and data pricing is now closely linked to household inflation, so to say. Do you reckon that while they have pricing power because it's an oligopoly or a duopoly, so to say, or whatever, let's say an oligopoly, while they have pricing power, will they be able to exercise this pricing power?
So, before that, Niraj, I want to tell you that these are illustrative examples as far as I'm concerned. And I'm just giving you my way of thought process, right?
Yes, please.
And
thank you for making that clear.
Right, and I myself will change my views as things evolve. It is just for our learning and sharing that we are making these comments.
Yes, Rajesh.
Now, as far as telecom is concerned, there is some bottoming out of pricing power that we've already seen, thanks to this enormous consolidation. So it is not as if will pricing power come. You are taking step increases in pricing power. Now, of course, this pricing power will need to get absorbed by customers who are used to a certain amount of tariff. So I think the telecom companies are also doing it over a period of time so that these are absorbed. I think in terms of direction, I think it is very clear. And I think some of the leaders in the business have also pointed out that that is a direction of pricing that they are moving towards. So it's not a question of if, it is a question of when. So my sense is that tariffs will move eventually upward. There may be the nature of speed, etc., is something that can be debated. But I don't think the direction can be debated. So from a secular point of view, my sense is the tariffs are moving up. And that is certainly given a lot of the capex is already done, minus 5G. My sense is incremental EBITDA will move very sharply to incremental PBT. And therefore cash flows. So that's also something that you will see, as you move forward as far as these companies are concerned.
Got it. Well, I'll reiterate the point that Rajesh was making. Please remember, viewers, any of these conversations, the previous one or the current one, are not meant to be in any fashion buy, sell, hold, ideating conversations. None of the conversations on BQ ever are. But it's just to give you a sense of what some of the better minds in investing are thinking about, how they are thinking, and if that helps you in trying to develop your thought process as well. Now, since Rajesh runs a long short fund, let's try and since he believes that there could be a possibility of a downside in the markets, even after this 15% decline that we've seen, while he's given us things that for now look like having good earnings momentum and then maybe holding on expansion, holding on the multiples. What about the converse? Rajesh, where is it that you believe there are challenges? What are the themes?
So if you could go to the next slide, some of those will be presented there. So again, this is even more tactical for us. I want to tell viewers that shorts are something that we do for short term, and therefore we can change our views very, very quickly. Having said that, again, what have we been talking about? We've been talking about an inflationary environment. We have been talking about slowing growth, and therefore there will be challenges to passing on these inflationary costs, which can impact profits of companies. And given that context, if some things are valued expensive, those become good short-term themes to play. One of the themes that we are talking about, let us say, is consumer electronics. Now, in certain segments of consumer electronics, we are seeing intense competition for market share as well, along with the challenge of cost increases and the K-shaped recovery that we have been seeing, which is weak consumer demand. So that is a very potent cocktail. And some of these consumer electronic companies are quoting, given that we are a very long only market, the long only guy wants to bet on these quality companies for a 10-year period. So these are quoting as if they will have smooth, long-term, significant earnings CAGR, whereas there are some shorter-term, 1 year, 2 year challenges that are manifesting themselves, which is not at this moment being recognized. So those become very good opportunities. There is great margin of safety in terms of the valuations they quote at. Some are quoting at 30 to 48 times earnings when they are seeing challenges in earnings, right? Some of them may be good companies, but my sense is that they are going to see earnings cut. Please look across the results. There have been margin contractions across businesses, right? So my sense is that some of these become very good opportunities for us to short. So consumer electronics is one area that we are seeing this rising competitive intensity, which means pricing is not going up as much as cost increases. Demand continue to be sluggish, and valuations are pricing in far smoother earnings than what is going to get reported. The second business is unfortunately the asset management businesses, or to some extent even capital market related businesses, which we think can be challenged in case our view is that the markets are going to be challenged, right? So that if you look across, the leading mutual fund players have been losing market share because there is far greater intensity of competition again in this business, right? And so instead of having pricing power, their yields are actually going down by a few basis points every year. So this is the opposite of pricing power, whereas the costs are still going up, right? So you're losing market share, you're losing some basis points of pricing power, and your AUM is equity oriented. So in case equities do fall, it can have an impact on your profits. And these stocks are still quoting at good high premiums because we are still coming off a bullish mindset of the market, right? So again, these become fairly good shorts for us. Then the obvious one is metals. Given that a context I told you that the world is seeing a slowdown, I think there will be pressure on these prices, as we move forward. I can tell you there are many more themes, more than we can accommodate, given the premium valuations and yet not considered the change that is happening on the growth or on the valuation side. So as you move forward. But again, a caveat, we are extremely nimble on our short side. We will take our shorts very, very quickly wherever we feel. But this is just to give you a certain thought process of how we are thinking about the short book.
Yeah, no, Rajesh, and thank you for these repeated disclaimers. But people shouldn't go short because Rajesh Bhatia believes that's a short call. What if Rajesh Bhatia is wrong? And I can tell you that he also goes wrong. So
absolutely.
So please don't follow it blindly in sense. Do your own due diligence. Have your own checks and balances in place. If you have questions, viewers, we have about 10 minutes left. Please put in your questions. I'll try and ask them. And I know a couple of people asked these questions, which I've already asked, including the things that Rajesh is short on. I just have one question, Rajesh, on metals. There's a bit of and I think investors will face this, that if they, for example, had metal stocks in the portfolio, and if they believe that these valuations are ripe and they get out of it, at some point of time, they'll confront a scenario of presumably falling metal prices, but the earnings release is still looking very, very robust. What happens in such a scenario?
No, my sense is that I think some of the results that you've seen as of the past, I think you're definitely seeing. If you look at aluminum prices, or if you look at the commentary on steel prices, they are moving towards the downside. And so my sense is that, of course, the delta on the upside is also significant, and so is the delta on the downside. It is for this reason that even the best players in metals quote at book value or, low single digit Ps, right? Because of this high delta and volatility in predicting these cash flows. Now, even if somebody believes that these are secular themes, now there is a thesis that nobody can build steel plants anymore, right? China is moving towards decarbonization. So is Europe, and so is Japan, and so is everybody. Where are steel plants going to come from? And if demand kind of keeps evolving, given that the world will move towards capital expenditure, then these prices are on a 10-year bull market, etc. Well, that thesis may prove to be correct. I'm not forecasting a 10-year metals price. I think the challenges are here and now for what we have, and I can clearly see that these were well-played thesis on the upside. And my sense is that if you're going to see a global growth collapse, the most obvious ones when you are playing a global decline is metal shorts. And we have seen that time and again, whenever global slowdown does manifest itself, metal prices do come off. So the here and now, unfortunately, is not in your favor.
So would ferrous and would steel, aluminum, ferrous, non-ferrous all look weak to you, Rajesh?
At this moment, yes. It's too early to, I think for aluminum also, people have a feeling that electric vehicles will need aluminum. New energy will require aluminum. But in my limited understanding of these things, my sense is at this moment, those are good long-term thesis perhaps, but let some of that get reflected for the moment in the downside, and then we'll see at what point in time to participate on the upside.
Got it. Rajesh, Tarun has a question that within auto, what is the view on tire manufacturers having global exposure, like Apollo or Balakrishna, versus domestic exposure with having more CV exposure, since you seem to be bullish on CVs, for example?
Yeah, unfortunately, I don't really have a strong view on the tire manufacturers.
Okay, fair call. Then one quick follow-up from mine again, and viewers, if you have more questions, yeah. And okay, Uday Nayak has this question. I'll ask that and then I'll ask my question. So Uday is asking that if you were a retail investor, what would be your strategy for the next coming 2 to 3 years to make sure that there is good compounding and lesser drawdowns? That's $1 million strategy, Rajesh, that I'm asking you for.
That's a good compounding
and less drawdowns.
Well, apart from investing in a long short equity fund, well, I don't know about the less drawdown part, because if you are going to, unless you have a strategy such as ours, you are going to be vulnerable to, if you're only long only, you are going to be vulnerable to a drawdown, etc.
Sure.
And so I'm not against, by the way, I've been a long only investor for a good portion. It's only the last 15 years that I've been a long short manager. So if you were, I'm assuming that he's going to be a long only investor, right? My sense is that if I were to be a long only investor, what I would do is try and find companies that, of course, I have a 10-year view on, where valuations do come to the lower end of the valuation band, and where I am ahead of the market to see that compounding. See, the best returns in equity markets are made when you're ahead. If it's already become an extremely popular business with demonstrated 10-year track record, chances are that you're not buying it at an attractive valuation. A lot of Buffett followers will know he buys mostly when everybody is selling. So he's buying at the wrong end of the spectrum, right? Now you have to also, even as we speak, he holds $100 billion plus of cash. While people say he has invested $40-50 billion, please look at where he has invested. He has invested in 2 dividend plays, which are oil related, right? And the third is an arbitrage situation. So he hasn't really given his veto on market valuations as such, right? So my sense is it's going to be a fantastic opportunity where if you can find, as things kind of move down, depending upon your comfort, you don't have to find the bottom. But if you can find something that you thought was a great business for 10 years, and you have the personal conviction that yes, this is what I can predict, right? Don't have to buy things that you can't predict, right? Where you have greater comfort that you can predict this for the next 5 or 10 years, and as valuations come up, that is when you need to pull the trigger. Unlike institutional investors, you don't have to take a call on markets or companies on a every 3 month or a 2 month basis. You can wait with your cash, wait for your opportunities, wait for everybody to get extremely bearish, and when that gets reflected in valuations, you can pull the trigger at that time. You can do exactly what Warren Buffett does. He has that kind of capital. So, as Peter Lynch would say, the retail investor has a greater advantage over the institutional investor. Uh, so that is really some of the thought process that I would kind of talk to a retail investor.
Thanks for that, Rajesh. Prashant Agarwal is asking that on the AMC front, since the number of investors and the quantum of investing in equity markets is increasing, if not asset management companies, what else is the opportunity to play that theme? More investors turning to equity markets.
On the long side.
Yes.
So, I mean, you've seen that in broking companies, wealth management companies. Those have also equally done well. So those will be, again, themes to play whenever this turns. In my opinion, if you think it's already turned, great. Those will become opportunities. But I think those are already there. CAMs, etc., all those companies which we don't own or cover. But those are, again, opportunities on the long side.
Okay. Fair call. Yeah. Again, didn't want names, but just wondering. Sure. Rajesh, a quick follow-up actually on metals. So Bharat Jain is asking that China lockdown opening may actually prompt metals to move higher, and if, as and when the war situation settles down, if indeed rebuilding Ukraine also involves some bit of that. So China, Ukraine, all of that, the US infrastructure plan shut down as it was, if it comes back into the play, all of those, do they help metals, or you still think that for now it is still headed lower?
Above my pay grade, but to forecast all
You're
of this.
You're being very modest.
No, above pay grade to predict all this. But my sense is the here and now is, I think the mind of the market is set on that there is going to be a global slowdown which is sharp. So the here and now is not in your favor.
Okay. And Rajesh, my final question, it was not, the theme was not in your list of the top places where you believe, where you might be more constructive on, or where you might not be so constructive on. But everybody wants, as a bunch of people who want a view on financials, rate cycle impact, even otherwise, FIs exiting, all of that put together, classic cocktail, heaviest weighted sector. What are your thoughts?
So my sense is, see, the competitive advantages of some of the large private sector financials is intact. In fact, it is only improved. At some point in time, we will have a credit cycle which will require capital. And my sense is that these guys will be the ones to provide that capital and credit growth. These are still guys who are going to gain market share as you move forward. So whether it is CASA, whether it is cost to income, whether it is lending discipline, all of the ingredients are still the same. And whenever credit growth does return, my sense is these guys will be, again, secular growth stories and fast growers, as you move forward, gaining market share. It's a problem of valuations, over ownership, and selling by FIIs that has probably led to some underperformance of some of these financials. So these are temporary issues. My sense is when this turns, these will again all become very attractive plays. So the one thing that I would always encourage people to look at, especially if you're playing financials on the secular side, is look for lending DNA. Are you comfortable with the management's lending DNA? Every problem that has been caused in the financial sector is when it was very obvious to begin with that this is not the lending DNA. People got enticed by growth rates, right? But did not realize that the lending DNA of that organization is not something that you should bet on a secular basis. So rather than look at CASA or cost to income or other ROE uh, and growth. I would say that that's the most important uh, element that you need to look at when you're looking at these kind of plays on a secular basis.
Great. Rajesh, this helps because people should try and figure out that the only way to make money is not buying and selling at times. Maybe exiting if you don't want to short a theme, or maybe even shorting it at the right tactical opportunities is a great way to do it. And as Rajesh opened up our eyes to, actually from an industry perspective, it's a really huge industry, the long short funds. So interesting. Rajesh, it was great. Thank you for coming on BQ. This is the first time that we're talking, unfortunately, but I look forward to talking to you many more times over the course of this year.
Look forward to it. Thank you for your time.